for employment economics. He's a great guy, and he's done a lot of great work on this, and he's an amazing teacher. So yeah, we'll start. So just explain the functions of money will be what we go through. Describe the components of the Canadian money supply. Describe what backs the money supply. Discuss the structure of the Canadian financial system. Explain the main factors that contributed to the U.S. financial crisis of 2007-2008. Explain the fractional reserve system used by Canadian charter banks. Explain the basics of a bank's balance sheet and distinguish between a bank's actual reserves and its desired reserves. Describe how a chartered bank creates money. Describe the multiple expansion of loans and money by the entire chartered banking system, and define and calculate the money multiplier. So money is what money does. So money is a medium of exchange, allows society to escape the complications of barter. Unit of account, we measure the value of goods and services in dollars. Store of value, possible to acquire goods and services at a future date. Liquidity, these with which an asset can be converted to cash with little or no loss of purchasing power. So money definition M1, currency is coins plus paper money. Token money, Bank of Canada notes are under the coins paper money. Demand deposits are deposits put in the bank. And that's about 75% of M1. So whatever you put into your bank as a deposit, that's about 75% of the M1 money supply. And then two qualifications. So currency held by the Bank of Canada and charter banks is excluded from M1 and other measures of the money supply. Also excluded from the money supply are any deposits of the federal government or the Bank of Canada that are held by charter banks. Money definition M2, M1 plus near monies. Near monies are highly liquid financial assets that do not directly function as a medium of exchange but can be readily converted into currency. Examples are currency or funds in non-checkable savings accounts. Term deposits become available to a depositor only at maturity. M1 plus is a narrow definition of the money supply that includes currency in circulation and demand deposits. Figure 14.1 shows that currency, coins, and paper money constitutes 8% of M1 plus. So as you can see here, currency is 8%, while demand deposits is 92%. So demand deposits are held by banks. So like held by banks. Yeah. And then M2, M2 plus, and M2 plus plus are broader definitions that include M1 plus along with several other account balances. So money definition M2 plus and M2 plus plus. M2 plus are deposits at trust and mortgage loan companies, deposits at Caisse Populaires, credit unions, and other non-bank deposit-taking institutions, money market mutual funds. M2 plus plus is M2 plus Canadian savings bonds and non-money market mutual funds. Money is debt. The major components of money supply, paper money and demand deposits are debts, value of money, acceptability, legal tender, and relative scarcity. So money is given value. Money has its value because it is accepted everywhere. It is guaranteed by the government. And it has limited supply. There is massive value in scarcity. So I'll ask the class, what else gives money its value? Okay, that's okay. Just try to think about that and try to figure out what else would give it value. And you can get back to me when you can. So, what backs the money supply? So the purchasing power of the dollar is one divided by the price level. So the price level is one, then the value of the dollar is one. If the price level rises to 120, D falls to 0.8333. So you do 0.8. So you do 1 divided by 1.20 equals 0.833333. Then a 20% increase in the price level reduces the value of the dollar by 16.67%. And you would calculate that to be 1 minus 0.8333, and then you get 0.1667 here. So inflation acceptability. So low inflation keeps the money supply, the money value stable. So like it's important to have low inflation for a strong currency value. And then Canada's charter banks. So they're a multi-branch, privately owned, chartered financial intermediary that has received a charter by the Act of Parliament. Fractional reserve banking system is a banking system with a reserve ratio that's less than 100% of the deposit liabilities of a charter bank. So they so what happens is the banks take in deposits. So so we're at slide 11, so we'll come back here. I'm just gonna create a whiteboard here. So what happens is the uh, banks take in deposits from us. Uh, so that's what happens, and then the banks use these deposits to lend to people and businesses for mortgages and other loans. And then the loans, the mortgages, the mortgage/loan interest is paid to the bank, and this interest is used for profit for the bank. So the bank makes its profit through lending money and receiving interest. And then the bank pays a small percentage of that interest to us as depositors, and the bank takes the rest in profit. So it's a pretty good deal. They have a pretty good deal here. The bank makes a very high profit margin and return on equity. Profit margin, cash flow, and return on equity due to this process. So that's how the banking system works. So no money is at the bank usually. The bank has lent out almost all deposits. So the bank has to borrow from other banks to 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 pay depositors back if they want to get their money out, because the bank has lent out their money. So if other banks cannot lend to that bank, then the bank asks the Bank of Canada to print money to print money that can be borrowed to pay back depositors. So that's how the banking system works. This is how the banking system works. So yeah, that's exactly how it works, and it has worked like this for at least 200 years. Yeah. So I'll put that in the chat for you so everyone can have that in the chat. So let's get back here. So Canada's charter banks are multi-branch, privately owned, chartered financial intermediary that has received a charter by act of parliament. It's a fractional reserve banking system. So banking system with a reserve ratio that's less than 100% of the deposit liabilities of charter bank. So so here so so good question, Britt. So what gives money its value is so it's accepted everywhere. It is guaranteed by the government. It has limited supply. So it having limited supply is a uh is important because rare things are more valuable. So like if something is rare, it has more value because it's hard to find. And then also money is guaranteed by the government. So that provides security to people. And also every store accepts it for payment. So like through all three of these reasons are why money has value. But I'll ask the class another question. Can you think of more reasons why money has value? So I'll ask Britt, can you think of any other reasons you would think money has value? Or anyone else, Britt or Faye or Nishla or um, anybody. Oh, that's okay. Yeah, those are the three main reasons. There's some like those are the three main reasons. There are some others, but those are the three central ones. But let me know if you think of any other reasons. I'd love to hear everyone's thoughts on that, on why money has value. Also, I'll bring up another reason. The money, a stronger economy increases the value of money. So the US economy is the largest in the world, and they have the strongest slash most trusted currency, mostly due to their strong economy. So that's a big reason. Also, low inflation is a good way to strengthen a currency. So an inflation rate of 2%, so an inflation rate near 2% is best to keep money at a good value. So those are very important reasons why. And then, so here's the bank balance sheet. So they keep about, if this is in billions of dollars, so they keep about 318. So reserves here are cash. They keep 318 billion in cash reserves. And then they would keep the rest. They would put the rest in loans. So the rest would be in loans here. So all of the rest of the money, roughly 3.5 trillion, is in loans to receive interest. So banks usually lend out more than 90% of their deposits to earn interest, and they may keep about 10% in cash just for funding deposits, the funding so just for giving back to depositors if they need their money, or if the bank needs needs cash to support itself, uh to support itself. So that's how the banks usually work. They keep a bit in cash just in case. So that's important. They keep usually, sometimes it's 10%, but lately in Canada it's been less. So in Canada they have kept much less than 10% in reserves. So they are taking more risk. They have been lending more than 95% and keeping less than 5% in cash reserves. So that can be a risk. That can be a risk because the bank may not have enough cash to fund withdrawals by depositors or to fund their bank operations. Yeah. So global perspective. So the world's 12 largest financial institutions 2018. The world's 12 largest private sector financial institutions are headquartered in just 6 countries: China, Japan, the United Kingdom, the United States, France, and Germany. So the biggest bank in the world is ICBC in China, which is over 4 trillion assets. China Construction, which is about $3.5 trillion in assets. The Bank of China, which is just over 3 trillion in assets. Mitsubishi Bank, which is just under 3 trillion in assets. HSBC, which is about 2.5 trillion in assets. JP Morgan Chase was about 2.5 trillion in assets. BNP Paribas, which is about 2.5 trillion in assets. Bank of America, which is just over 2 trillion in assets. Citigroup, which is just under 2 trillion. Wells Fargo, which is under 2 trillion in assets also. And then Sumitomo Mitsui in Japan, which is just under 2 trillion. So other financial intermediaries in the banking system are trust companies, loan companies, credit unions, Caisse Populaires, and insurance companies. So two basic functions: they hold the money deposits of businesses and households. They make loans to the public in an effort to make profits. We're going to go through what happened in 2008. So there were a lot of issues in the financial market in 2008. Because of subprime mortgage loans. They were high interest rate loans to home buyers with higher than average credit risk, and they were promoted by government programs that encouraged home ownership. So this led to massive problems in our economy because people, they were high risk borrowers and they couldn't pay back the loan. So these people, so in the US in the 2000s, many mortgage loans were given to people that couldn't pay them back. So then when they started not paying them back, the whole banking system collapsed because the banks were not receiving their interest and principal back. So what caused the skyrocketing mortgage default rates in the first place? So bankruptcies, government programs that subsidized home ownership, and the bursting of a large financial bubble in real estate values, bad incentives provided by the mortgage-backed bonds. Many people took on too much mortgage and were soon failing to make their monthly payments. So home prices began to decline. Borrowers with small down payments discovered that they owed more on their mortgages than their properties were worth. Lenders began to foreclose on many houses. Mortgage-backed securities plunged, driving several large financial firms either into bankruptcy or right to the edge of bankruptcy. A true collapse of the U.S. financial system suddenly became a realistic possibility. So, so during 2008 housing crisis, they had to bail out banks, AIG, insurance, and the auto companies to avoid a next Great Depression. They avoided a Great Depression, but they still had a large recession. So it was a huge recession regardless. So back to the fractional reserve system. It's a system in which only a portion of demand deposits and cash reserves is held in the charter bank vaults. So the creation of money is done with the help of Canada's charter banks by issuing loans, depository institutions create demand deposits, i.e. money. So illustrating the idea of the goldsmith. So early traders realized that it was unsafe and inconvenient to carry gold for every transaction. Goldsmiths accepted gold deposits and issued paper receipts, i.e. promissory notes. These paper receipts were used as a medium of exchange, 100% reserve system. So once so they started using paper receipts. They used paper receipts in place of gold for paying for things. So people stored their gold in the vault. The bank gave the people paper receipts as proof that they stored their gold in the vaults. The people used the paper receipts to pay for things, and the people who received the paper receipts as payment would have the rights to that gold. So they would own the gold now. Then eventually they just got rid of the gold and it was just paper receipts when they got rid of the gold standard. That was how modern money was created. So now instead of all money being backed by gold, money is not backed by any asset. The government can print as much as they want, but it is guaranteed by the government. and the government makes sure that they will honor the value of money. So that's how things have changed. So the government can print as much as they want now. They don't have to worry about backing it by gold. So the governments can print as much money as they want, and they don't have to have gold to back that money. Yeah. So afterwards, goldsmiths realized that paper receipts could be issued in excess of the amount of gold held. These receipts, redeemable in gold, were put into circulation by making interest-earning loans to merchants, producers, and consumers. Borrowers were willing to accept loans in the form of gold receipts because they were accepted as a medium of exchange in the marketplace. So significant characteristics of fractional reserve banking, money creation reserves. Banks can create money through lending. Bank panics and regulation. Banks operating under a fractional reserve system are vulnerable to panics or runs. Deposit insurance. So the Canadian Mortgage and Housing Corporation. Sorry, the Canadian Deposits and Insurance Corporation, CDIC, insures deposits up to $100,000. So like for the big banks in Canada. So that keeps people secure, because if they have money in Bank of Montreal, CIBC, Scotiabank, TD Bank, RBC Bank, their deposits are guaranteed by the government up to $100,000. So that's a guarantee, 100%, in any case. So if any of these banks go completely bankrupt, the depositors are secure. Up to $100,000. Yeah. So balance sheet, it's a statement of assets and claims on assets that summarizes the financial position of the bank at a certain time. Every balance sheet must balance. The value of assets must equal the amount of non-owner liabilities and owner net worth claims against those assets. So assets equals liabilities plus net worth. So formation of charter bank. So creating a bank, you got to acquire property and equipment. You need to accept deposits. You need to clear a check drawn against the bank. You need to grant a loan. You need to buy government securities. So transaction number one, vault cash is cash held by the bank. And then you got to acquire property and equipment. So use cash and property would be assets in this case. And then you accept deposits here. And then desired reserve ratio is charter banks' desired reserves divided by charter banks' demand deposit liabilities. So this is used for this is what you want. So desired reserve ratio is the percentage of cash you want to keep at the bank and not loan it out. So excess reserves are actual reserves minus desired reserves. Desired reserves, demand deposits times desired reserve ratio. So in this case, actual reserves. So to get excess reserves here, you do the 110,000 here minus 100,000 times 20%. And then you get 90,000 in excess reserves. So that's how you would calculate the excess reserves in this case. You would do, so what you would do is you would do excess reserves equals actual reserves minus demand deposits times the reserve ratio. And this shows how much reserves extra that you have. So you want to lend out your excess reserves because excess reserves don't do anything. It's just cash. So cash doesn't earn interest. So you want to lend out cash / excess reserves because you want to earn interest and make a return. Cash doesn't earn anything. It just sits there. You would rather invest it or lend it to earn interest. Yeah. So that's really important. You want to make sure that cash is lent out / invested. So check clearing. So a check is a written order that the drawer uses in making a purchase or paying a debt. A check is cleared when one or more banks transfer part of the drawer's checking account to the checking account of the recipient. The Canadian Payments Association, CPA, was set up in 1982 for interbank check clearing and electronic payments. So clearing a check, a $50,000 check reduces reserves and demand deposits. Granting a loan, $50,000 loan deposited to checking. Using the loan, $50,000 loan cashed. A single bank can only lend an amount equal to its pre-loan excess reserves. Government securities. So bond purchases from the public by the charter banks increases the money supply. Bond sales to the public decreases the money supply. So bank pays government securities. Buys government securities from a dealer. Deposit payments is checking here. So if so to show this, if the government buys bonds from the bank, the money supply increases. If the government sells bonds to the bank, the money supply decreases. So that's what happens with this here. So profits, liquidity, and overnight lending rate. So bankers have two conflicting goals: profit and liquidity. So overnight loans rate paid on government overnight loans to cover temporary shortages of reserves. So single bank in a banking system can lend $1 for each dollar of its excess cash reserves. The situation is different for all chartered banks as a group. The banking system can create money by a multiple of its excess reserves. Multiple lending is accomplished even though each bank in the system can lend only dollar for dollar with its excess cash reserves. So assumptions, 20% desired reserve ratio, all banks loaned up. Banks lend all of their excess reserves. $100 bill is found and deposited. Multiple deposits can be created. So this is how the fractional reserve system works. So this is how money is created. So basically what happens here is the bank like bank A leaves 20% in cash reserves and then lends out 80% in loans. Then the person who borrowed from bank A deposits into bank B here, and then bank B lends out 80% of that deposit and keeps 20% in cash reserves. The person who borrowed from bank B deposits into bank C. Bank C lends out 80% of that deposit and keeps 20% in cash reserves. The person who borrows from bank C deposits into bank D. Bank D lends out 80% of that deposit and keeps 20% in cash reserves. And so on and so on. This repeats itself over and over, and more money is created through this process. So this is what they call fractional reserve lending. So that's what they call fractional reserve lending. So it's just a repeating process, and that's how money is created. Put it in the chat for everyone here. So as you can see here, $400 in this case is made. So you create, so $400, as you can see here, I'll annotate. So here, $400 is created. So through this process, $400 is created compared to 100 at the start. So like so the money supply increases from 100 to 400 through this process of fractional reserve lending. Yeah. So it's a pretty it's a pretty crazy process how this happens. It's very there's a lot grows here. So I'll put this in the chat for everyone here. The money multiplier defines the relationship between any new cash reserves in the banking system and the magnified creation of new demand deposit money by banks and as the group. So you take, to get the money multiplier, you do one divided by the desired reserve ratio in this case. And then maximum demand deposit creation is excess cash reserves times money multiplier, and you figure out how much growth in the money supply will happen. So money multiplier times excess reserves equals equals what the money supply will grow to after the bank lends out excess reserves. So that's what happens. So the money multiplier shows how much growth there will be in the money supply after lending out excess reserves. Yeah. So you have $80 excess reserves and $20 in desired reserves. And then $400 would be lent out of a $100 initial deposit. So this is a good description here. So this is what happens usually in banking. So this is usually what happens in a bank. So like 400 of money is created from 100 investment, from 100 deposit. So so the money supply increases from 100 to $400 due to lending. Yeah. So that's how they can create money. So like bank A lends to customer A. Customer A deposits into bank B. Bank B lends to customer B. Customer B deposits into bank C. Bank C lends to customer C. Customer C lends to, customer C deposits into bank D, and so on and so on. This creates more and more money. The last word, in responding to COVID-19, the Bank of Canada set the monetary multiplier equal to infinity. Leverage boosts banking profits, but makes the banking system less stable. Time to reduce leverage. So they just kept printing and printing money. So the U.S. government and the U.S. government led this. So the U.S. government printed effectively limitless money. They had a program called Infinite QE. That means that they were printing so much money that it wasn't, like, so much money that it was infinite, basically. So as part of this response to the COVID-19 crisis, the Bank of Canada provided the charter banks with almost limitless excess reserves to lend out to individuals and businesses across Canada. So the central bank lent, like, RBC, TD Bank, Scotiabank, Bank of Montreal, National Bank, and other charter banks in Canada at, like, limitless money, almost limitless, to lend to people across Canada to to keep the economy growing in the COVID-19 pandemic. So does this mean that the money supply will rise to infinity and we'll get huge inflation? So not at all. The multiplier can achieve its maximum only if charter banks can find a lot of qualified borrowers. So that's an important point here. What they said here, it really depends on qualified borrowers. The bank could have trillions of dollars to lend, but they wouldn't lend if there are not any qualified borrowers. So that's a really important point there. But this may have still contributed to the high inflation we saw last year because of the much higher money supply. I'll place this whole slide in the chat here. So leverage boosts banking profits, but makes the banking system less stable. Time to reduce leverage, but now there's likely during a deep recession. Lending will be slow because many people will lose their jobs and sales for many businesses slow down. Unemployed workers and businesses without many clients would have a difficult time borrowing from charter banks. Thus, the actual money multiplier during a deep recession will be much lower than the maximum money multiplier. So there should be no risk of high inflation in the short term. Yeah. Excellent job on the questions, everyone. Very impressive job. So I want to go next task here. I want to go more into the global financial crisis. So let's get started on this. So, background of the 2008 financial crisis and why it happened. So in 2008, the United States experienced a major financial crisis, which led to the most serious recession since the Second World War. Both the financial crisis and the downturn in the US economy spread to many foreign nations, resulting in a global economic crisis. So why did this happen? The answer is simple. The housing bubble burst. Between 1997 and 2006, the price of the average home increased by 124%. Price went up, demand of house went up, mortgage interest rate went down, and then there was relaxed lending standards. So the relaxed lending standards led to people without high or medium incomes getting homes, and they were not able to pay the mortgage payments, and they had to default on the loans because they couldn't pay it back. This caused a housing price crash due to the market being due to the loans not being paid back and the houses being on the market after, leading to oversupply of houses on the market, and the prices went down due to oversupply. So subprime lending is giving a loan to people who may have difficulty in maintaining the repayment schedule. These loans are characterized by higher interest rates, poor quality collateral, and less favorable terms in order to compensate for the higher credit risk. So a lot of it has to do with higher interest rates. You're given a higher interest rate because you're less likely to pay it back. There's not a lot of collateral to secure the loan, and then also less favorable terms. So people, they have low incomes, and there's not a lot of security in the loan. They aren't able to put up a large enough down payment, and they're not getting paid enough to pay the mortgage. Other causes, financial deregulation. So there was not as much regulation in the financial markets, new complex innovative financial products, and the shadow banking system. So what they were doing was they were creating mortgage bonds that people were buying with very high risk mortgages in these bonds, and people were buying them and they were losing money because these mortgages were of very high risk. So that's what was happening, and people that didn't have very a background in finance were being told that these bonds were of low risk, even though they were very high risk. So they were losing money because they were misled, and this led to investors losing a lot of money banks losing a lot of money, and people being evicted from their houses because they weren't able to pay the mortgage because they were high risk borrowers. So what they did was they pooled AAA rated bonds, which are very low risk here. So they pooled AAA low risk right here. And then the Bs are more high risk. So anything that's B is a high risk mortgage, more high risk mortgage. So they put them all together. They put AAA, AAA, A, triple B, double B, B, and Bs together into one bond. And the problem was high risk mortgages were also being labeled as AAA, AA, and A, thereby misleading people. So like high risk mortgages were being labeled as any of these ratings. So no one knew which one was high or low risk because they were being rated as AAA when they should have been triple B, let's say. So it impacts GFC. So the impacts on the financial markets and affects the global economy. So effects on global economy. So global decline of economic growth. In June 2009, the Brookings Institution reported that between 2000 and 2007, consumption in USA accounts for over a third of the growth of the global consumption. The first quarter of 2009, the annual decreasing rate of GDP was 14.4% in Germany, 15.2% in Japan, 7.4% in the UK, 9.8% in the euro area, and 21.5% in Mexico. Developing countries, slowdowns of economic growth. For example, the growth forecast in Cambodia is a fall from over 10% in 2007 to null in 2009. USA's economic effect. So real GDP by labor and property decreased by about 6% in the fourth quarter of 2008 and first quarter of 2009. Unemployment rate was 10.1% in October 2009, which is the highest since 1983 and twice the pre-crisis rate. Lower GDP implies lower innovation and investment, and thus lower growth rate in the long run. So the U.S. government expanded money supplies in the short term and increased regulations long term. So they spent a lot on bailing out. So they spent a lot to save the economy through increasing employment insurance, bailing out banks, car companies, and AIG insurance, and lending to banks to lending in the government lent to banks so banks can lend to people and businesses. So that's what they did this, and also they increased the money supply. This was all used to get the economy back out of recession. And then increased regulations long term, increased regulatory proposals US, increased Basel III regulations Euro. So they increased regulations on banks. The US government and Eurozone increased regulations on banks, ensuring that people that lending to people, that lending had to be to people that could afford the mortgage. So they regulated banks so the banks wouldn't do these high risk lending practices. They would have to make sure that people could pay the mortgages before lending to them. Yeah. So that's the financial crisis. That's how it happened. It was one of the worst ever. It was